You're listening to the Real Estate Runway podcast, powered by Quatro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, everyone. Welcome to another episode of the Real Estate Runway podcast. This is the first ever Quatro Roundtable, numero uno, the OGs. All of us are here, except one who's down with COVID. So miss you, Kim. We'll get you on the next one. Before I introduce my awesome team, everyone, if you get any value out of this show whatsoever, please roll over to wherever you're listening to this on and give us a 5-star comment and a thoughtful review. Those are worth their weight in gold, and it's the only way to increase the reach of the show. You can also follow us at our parent company, Quatro Capital, on Instagram, Facebook, LinkedIn at Team Quatro Capital, one word, no special characters, or by visiting us at thequatroway.com. We love your feedback, and we'd love to hear from you. If you have any content requests, feedback, or just want to say hello, drop us a note at podcast@thequatroway.com. And if you want to be on the show, visit us at thequatroway.com/podcast to apply. And now, on for your scheduled production. Everyone, welcome to the show. We've got with us Quatro partners Erin Hudson, Maurice Philogene, also known as Maurice, but he hates it when I call him that, and the one, the only, my mother, who forgot to dress up for the show today, Tammy Sutton. Welcome to the show, Team Quatro.
Nothing like getting called. Somebody wasn't informed either.
See, what you guys don't know is my family is spending Thanksgiving apart because my mother and father are down in Texas visiting their parents. We do that every now and then. And so she can't reach me through the computer to hit me for saying that. So it's okay.
Exactly.
But everyone, what we want to do here, we've decided it's good to get some of the other partners on here and really have a Quatro roundtable to just kind of talk a little bit about what we're seeing in the market, what we're, where we're going, how investors are feeling, just all the things that reflect our interaction with you and where we're going as a company. So this is the first ever episode like that. And today we're going to just talk about where we are. As of this recording, it is November 22nd, 2022. It has been a wild ride of a year. We're going into some interesting time of opportunity. So what I'd love to do is maybe just kick us off with one of the three over here and just say, what have you been seeing out here today? What's different in this market? And let's start there and we'll just see where this goes, huh?
I'll go. You know what I'm seeing? Awareness and enlightenment by investors, by people. That's what I'm talking about. We all went through a downturn. I went through a 2008 downturn. We're in some kind of downturn right now. I don't think it'll be as bad because the mortgage industry is on solid footing, different from what was happening in 2008 with the subprime stuff. But people who were in line to retire through 401ks, IRAs, what have you, by the stock market, they can't retire anymore. Not right now anyway, with the market being down 20, 30, 40%. I was corporate for 25, a pretty sizable 401k. Before I made a move, it went down by 30%. Fortunately, I don't need it to live on or for my future, per se. I need it for other goals. But that's because I have real estate and other assets to take care of stuff. So what I'm seeing and hearing from people is, oh my God, do you mean that for a 401k, there's timing associated with when I can roll out? And that's what the industry will never tell you. They'll never tell you two things. They'll always tell you like, hey, systematically send your money over, prepare for your future. What they don't tell you is, one, I hope the timing is right when you're taking that money out for retirement. And two, which we don't necessarily need to get into, but don't worry, pay me 3% in fees. If somebody else comparatively on the same fund is paying 1% in fees, the guy with the 3% is getting 65% less on the long-term growth of that money. So I love the fact that people are starting to see it. It's unfortunate that people are feeling it in a negative way. I also like the fact that they are feeling it now so they can adjust, make changes. Quattro can be an option, but I just want people to be in control of their financial destiny in general. That's kind of what I've been seeing and having conversations.
I'll jump on that. Being a prior state employee working in education, we have these wonderful things called pensions. And, they'll tell you at a certain age, you're going to get paid a certain amount for the rest of your life. Well, what they're not telling you is, say I get paid $1,500 a month for the rest of my life. The $1,500 today is not going to be the same as $1,500 later. So yeah, you may have a pension and it may be protected and it may not go away, but it sure as heck not going to be the same amount of what you're thinking it is today.
That's said so well. And I think that I actually had a banker tell me this one time, like, sure, I can create a product that guarantees you X amount of money for the rest of your life, but I can't guarantee how much that money is going to buy you. It might buy you a carrot by the time you're done,
Right. Yeah. It's a little disconcerting when you think about it, though.
And I also think, even just to add on that, yeah, people are in a place where they're feeling like they're in a world of hurt with these losses. And I love that many people that have been in the stock market for so long are now open to exploring what it might look like to work with Team Quattro. I think the idea of doubling your money in 5 years leaves them in a place where they're like, oh my goodness, well, it was a lot of this in the stock market. Now you're telling me that I can come in, link arms with you and double my money in 5 years. So I think people's curiosity is absolutely peaked. And I mean, who's not looking to work with a really strong team? And so that's what we are with Team Quattro.
Absolutely. And it seems like what everyone is starting to realize is there are ways, and these are not what are broadcast and instilled into our being, as we become young adults, middle-aged adults, and so on. There are ways to grow your money that have asymmetric risk. What do I mean by that? If you're in the stock market, unless you're really, really good and can beat the hedge funds and all their supercomputer calculations and things like that, you're probably going to have just as much probability of going up in your investments as you are going down. That is a symmetric risk. Your ability to go up and down is exactly the same, right? When you start to look at some smarter investments and you start to watch where those who have a lot of money put a lot of money, things like real estate of different types, things like, well, dare I say, using life insurance as an investment vehicle. There are things that we can talk about there. But what you think about is you can quantify the upside gain, but you can also quantify and to a large degree mitigate the downside risk. It's called an asymmetric return. And that's, I think, what people are starting to gravitate towards more. I've had a lot of conversations about that, when it comes to like tax lien investing and multifamily investing and so on ever since then. So anyway, just, stack on that.
I like that point. And favorite financial book is Money Master the Game. Tony Robbins wrote it, but it's not about Tony. What he does is he interviews all the masters, right? Like Ray Dalio, Sir John Templeton before he passed on, Warren Buffett, just guys and women like that. And Ray Dalio talked, Ray Dalio or Tudor? I think it was Ray Dalio, talked quite a bit about asymmetric risk reward. And if you go after 5 investments and each investment has the ability to 5X, you just have to be right on one to break even. Right. We're used to investing in a very linear way when there might be ways of supercharging each one. You just have to find the right vehicle. And that's kind of what a Quattro does, or other folks as well, but bring awareness to other investment and life related vehicles that have that potential. It's not mainstream. All you get on TV is just stocks and bonds, things of that nature. So people got to take control. But a good book. Money Master the Game. Highly recommend.
I think that's great. It's always good to have nice books out there, but I think that also let's be real for a moment. Not a lot of people know that they can even invest in apartment buildings. Like for me, for example, you just had to be, a multi-millionaire, billionaire to own apartment buildings. So if I thought that, I can't be the only one out there that had that same mindset. So when people learn that there is potential and that you can come together with other folks to purchase apartment buildings, it's extremely enlightening. So I think that's really what Team Quattro is on a mission to share with the masses, that there are other ways, and it doesn't have to just be stocks, bonds, and single family rental properties, which, don't get me started, there's a lot of liabilities that come with owning single family. Speaking from a place of having been there. And even with 26 single family properties I owned, I still find multifamily much more favorable for an array of reasons. So it's just exciting to share with others, most definitely.
I'll jump on that and say one of the things that really got my husband engaged in our company is our very refined investment criteria. we're getting those solid returns at a low risk because we analyze how many, Chad, probably hundreds of cities and neighborhoods across the country before we find one that we decide to put an LOI on. I mean, the vetting process is very, what's the word I'm looking for? Comforting to my husband, knowing that when I say, guess what? You're investing, Hubs. He's real comfortable with because he knows what we've done and he knows that we're protecting our money. So
that's awesome.
Let's
go. Why don't we dive into that, Chad? Let's talk about what we do when we vet a property and what are all the things that we're looking at to decipher if it's a bite, if it's a go. We want to dig in further.
Yeah, absolutely. Thanks for that question. And, it all starts with market research, folks. Like you can rehab something anywhere in the world, right? I can go rehab something in Ethiopia, but I promise you, I'm probably not going to be able to lease it up at a profitable market rent for where I'm going to be spending the money. So it all starts with the location. Where am I going to put this money? Are people moving to the area? Are there good jobs in the area that have wage growth? Do you see the city investing money? Do you see companies investing money? It's all about following the people. And so we look at several metrics, that really, I won't dive into them here, but we look at several metrics that really tell us where are the jobs and where are the people. It's that simple. And we want to see migratorily, where are they going? And it's pretty slow moving. So you can pick up on a trend that has started and ride that wave for the next, 5, 6, 7, 10 years, as long as it goes. And oh, by the way, when it turns the other direction, you can usually see it coming years before it happens. And so you can know when to get out of that area. That's why I love real estate, is it's slow moving. You don't have to be reactive in what you're doing. By the time we select the markets we want to be in, the macro level markets, let's say like a Houston, Texas, or like in Evansville, Indiana, like you got the city, we will then go and study the secondary markets of them, the little towns that support it. And we'll figure out in the sub-market perspective, where do we want to be in that city? Because I'll tell you, just saying something is in Houston, Texas doesn't mean I want to buy it. There's plenty of areas like Texas City, for example, where I would never go because I couldn't prevent a hurricane from smashing me up into bits, So that's one problem. But after we've identified that, then we can start looking at properties. We'll start networking with deal flow individuals, brokers and off-market individuals, sellers, those who are actually looking at it. Then we start looking at properties after we know where we want to be and what's the biggest bang for our buck. Then we go start looking at a couple of 100 or 1,000 deals before we may buy 2 or 3, that actually make a little bit of sense and have the right upside. So it's quite the top-down procedure, to get into a deal.
Absolutely. I was sitting here listening to you talk. We are so precise in the way we vet our properties that by the time it actually goes to our investors, I feel like we have all bases covered. And that's one thing that I really like about our company.
That's really
and the multiple exit strategies. That right there. I love that you come to the table with the multiple exit strategies before we ever go to our investors.
That's right.
Yeah.
That's all good stuff. I think even furthermore, yes, we're vetting prior to picking up and moving forward with a property, but it doesn't stop there. We are continually watching the market as we are owners of that, so we can see what's trending. What is the occupancy rates? What's coming into the area? Are the income, is it moving in the right direction with the rent growths? And so we've always got to make sure we have a pulse on that, because you never know. We might be making the move because of the way things are starting to trend, right? So we're always forward looking and making sure we've got a pulse on it. So good stuff for sure.
Yeah. And so going into forward looking a little bit, I mean, let's talk about what we're seeing out there in the market. Let's kind of let's synthesize some of this information that is coming into everyone's TV screens from CNN and Fox Business, whatever it is you decide to watch to get pulse on the market. So, it's no secret that we have been battling as a country inflationary pressures I can't speak English. We're fighting inflationary pressures that were caused by events that took place back in the pandemic timeframe where we had to inject some money. Regardless of your political affiliation, we had to inject money to keep the economy rolling. No one's arguing how well or how not well it was done. The point in it is it was done, and that greased the gears of the economy and kept the economy rolling. Now, we are reaping, unfortunately, the consequences of that, and that is we increase the supply of money 40%, and all of a sudden prices are starting to shoot up now that everything is catching up and demand is really driven that. So, we're in a situation today where the Federal Reserve has been increasing interest rates dramatically higher than we have since the 80s, the last time we had, stagflation / hyperinflation, if you will. I haven't really got to that level yet. And that is causing effectively a chokehold around the neck of the economy. And the question in everyone's mind is, will the economy pass out, or will we release the economy before, it loses all consciousness? So just curious where you guys see we are, where we're going, what you're hearing from your sources and things of that sort. But what do you think tomorrow holds with where we are today?
Well, I can tell you this. I feel like everyone is so worried about this inflation, which it's not fun, right? Who wants to have to pay double compared to what they were paying before? But also, we have to also find a way to make lemonade out of lemons, right? If inflation's going up in our space that we're in, it's actually not a bad thing if the rents are going up. At least those are trending upward, right? So I think it's unfortunate. It's out of our control, right? So we have to find and look for the positive in what's unfolding. And I think that's just my 2 cents on it. People get upset and they're really frustrated on what's happening just with inflation in general. And I think no matter what, it's out of our control. We've got to find the good in it. And so that's just one little piece that I think is positive.
And so let's talk about the good in it. I mean, the cool thing is when rates go up, guess what also? It's kind of a circular relationship. Rates go up. So all of a sudden, guess what? The already challenged home buyer who was struggling with where home prices were in the first place now has even less inventory to buy because some sellers just won't sell, because they have to go buy something else and they don't want to give up their 2% loan. Or B, just in general, if someone is looking for a house, their affordability gap is now so much larger because higher interest rate, less buying power. Sure. We're going to see some prices come down for a time. So be careful looking at real estate using national metrics. Everything is local, right? But nationally, we may see prices come down for a little while just because of that. But let's also remember that when the housing market is challenged, the rental market is boosted because now you have a larger patch of renters. And, we still, by the way, have this incredibly tight labor market. And the problem is that usually lags, what's going on in the interest rate environment and the economy. So we probably won't see the labor market start to soften until middle of 2023. But right now, employees still think they have all the power. They're forcing the work from home question. They are, jumping job to job because there's some like 700,000 job openings still out there today. Well, that number is starting to decrease. We'll see what happens there. But overall, in general, this is a good time to be doing what we're doing. Why? Because in our world, properties that sell right now, when interest rates are 2.5x what they were before, it's because of one or two reasons. The only way you ever get in trouble in real estate is you run out of time or you run out of money. Well, guess what happens? You run out of time when you originate bridge debt that has a short term, like maybe 18 to 24 months. And whether or not you've hit your business plan, you've got to go refinance into something else. Well, if you were planning to refinance into 2 or 3%, maybe 4% debt, and it's now 7 or 8, you're going to have a little bit of trouble getting all of that refi completed. And you'd even have to put money into the deal to refinance the lender out. People don't want to do that. That's going to cause people to sell deals. And that's going to cause them to sell at a time where they don't want to sell, which is lower price today because of acquisition debt. Now, the second reason you run out of money is because you run out of money. But let's think what's been happening. Inflation has been running rampant. CapEx plans are running over like crazy. You see a lot of properties hitting the market. Hey, 50% renovated. So awesome. No, they ran out of freaking money. That's what happened. That's why they're selling properties halfway through. It's not that hard to figure out. Okay. And so like the other part that causes you to run out of money is if you originated floating rate debt, there's this thing you can buy called a rate cap, and that just protects how high your interest rate can go. Well, 2 years ago, people were buying no rate cap or the highest and cheapest rate cap they could. So they thought they'd be paying 3% interest rate. They're now paying 7%. They are bleeding, folks. They're bleeding from the jugular, and they are going to bleed out. And the ones who aren't well capitalized will bleed out in the next couple of months. So when I say it is time to put your thinking cap on and start looking for deals and watch for those distressed assets, it's not going to be because the deal isn't doing well. It's going to be because they're running out of money or they're running out of time. So I'm so excited for this, by the way. I'm going to get off the soapbox, but go ahead.
As I say, and you got your pencil sharpened, ready to go.
I love that you touched on that. I think for a couple different reasons. I mean, it's very clear with what Chad's saying. It's about terrain properties and opportunities are about to be available. And I think, a lot of people in our space are sitting on the sidelines and they're like, man, I just got to wait for this to be over. It's just scary times with all this uncertainty. And I think that's where, Quattro is truly, truly leaning in. And we're ready for this rainfall because just like Chad said, there's going to be owners that are desperate to sell. They have got to get out. They ran out of money. Their time is up. The clock was ticking. The bomb is about to go off and we're here to retrieve, to clean up their mess. And so that's really where we're getting ready to seize the opportunity that's about to be placed before us. And so again, we're going to find a way to make lemonade out of lemons. It's not a fun time right now, but it's not going to stop us from continuing to move forward. And then the other things that I wanted to share is I really feel like it's important for people to understand that this space that we're in and buying multifamily is super recession proof. It's like if people cannot afford to be in these nice, beautiful homes and purchase any, where are they going to go? They've got to live someplace. And when people are looking to downgrade, they're coming to perhaps apartment buildings. And so we provide that place and space with affordable homes and a beautiful community for them to live in. And so I just feel like there is no better time than as an operator and as an investor to protect and preserve and grow the money during these crazy wild times.
Absolutely. But on the flip side of that, everybody thinks that lenders are freaking out and stopping and becoming very, very conservative. We've come up against that, but that does not mean there's not lenders out there that are ready and willing to work with us, and we are finding them.
I love that you said that, Tammy. Let's just go there. What are some things that we can share for other operators that are out there? Let's give away some nuggets that they want to look for prior to picking their lender that they're going to want to go with. Chad, you could probably fire away on this as well, just so we can give some nice, good nuggets back to our people.
Yeah, considering he's the one that vets the lender and then hands it over to me, I'm going to let him take that question.
Yeah, you have to watch where the money's coming from, everybody. And this is really always the case. When times are good, you can pretty much take money from anywhere because money is plentiful. Usually the best price lender in a time like this is not going to be the one you want to go with. And here's why. The lenders who package up a bunch of loans and sell them on a different market as a mortgage-backed security, that's called a secondary market lender. And those have been really prevalent. We've done a lot of loans with them. They're fantastic. But guess what? As soon as pricing on what they can sell those investments for starts to halt a little bit, they can't afford to originate a bunch of loans and not be able to sell it. So guess what they'll do? They're going to retrade or renegotiate the mess out of your loan mid-flight, or they're going to drop it all together, right? And so in times of uncertainty, you have to, unfortunately, even though they're the best price money, you have to pull back from those guys because they're just not going to be trustworthy, in this kind of a time. You really want to be focusing on balance sheet lenders. What does that mean? People who have money on their balance sheet. It is their money they're lending. They are going to be servicing the loan, and it is their product. They're not selling it to anybody. And then you have to ask the question, where are they getting their money? Is it coming from, discretionary pension funds? Is it coming from family offices? Is it their money and they already have it in the bank, which is preferable? Because what you don't want to be subject to is having to deal with, getting money from well, first getting your loan approved by this lender and then subsequently waiting on them to go out and get money from an investor, which is another layer of uncertainty. Ask me how I know this, folks.
I was just, how do you know this, Chad? How do we know this?
Well, we have actually experienced this 2 or 3 times where the balance sheet lender, and we've been through a couple of down cycles, so we've seen this in different flavors. This happens when you have a balance sheet lender, so they check that box. But the problem is they're not getting they don't have the money in the bank. You have to make sure they have the money in the bank and they can lend discretionary with that board that you're working with. Not, okay, it's board approved. Now let me go find an investor and get, then you have to deal with that volatility. So, because that can change on a whim. So that's first and foremost the thing you've got to be looking for is lenders that can originate their own debt and service their own debt out of their own capital. Now, the second part of that, you really want to think about longevity, okay? Now is not the time to be originating 18 to 24-month bridge debt. Why? Because you're going to be probably refinancing in a tumultuous time, which you don't want to do. That may force you to sell, which makes you have to take whatever number you can get, which is really bad when you only have one exit strategy that works. It's really bad. Then you're fully dependent on it. What you want to be able to do is, in times of uncertainty, don't take less than a 3 to 5 year loan. And when I say that, I'm thinking a 3-year initially approved term with 2 1-year extensions that that have hurdles you can achieve. Right? Make sure that whatever requirement comes for those 2 extensions, it's something you can realistically achieve, and not just in perfect world scenarios. Right? Because what you don't want to be doing is trying to consummate another loan in a time where you may not have a lot of suitors and you may, be in a down market. So, look for that medium-term loan. And the third thing to watch for, yes, I know it's tempting to go and originate fixed rate debt right now. Volatility does not mean originate fixed rate debt. That can be good. Banks are doing fixed rate debt for 5 years. That can be good. Mm-hmm. But if you go originate, let me tell you what's going to happen. If you go originate an agency loan right now, and you fix that bad boy at 6% for 12 years, and you put what's called yield maintenance or defeasance on there, that just means big prepayment penalty. Just remember that in your name or in your head. Well, what happens when debt is low, as in interest rate is low, and then it moves from low to high? Well, they want that money back. So they're going to make your prepayment penalty, it's calculated as a function of interest rate. That prepayment penalty will go almost down to 1% or 0 in order to, because they want that money back. They want to go lend it out at higher rate. Well, guess what happens? If we're at a high interest rate environment, let's say 6.5%, 6%, and then you lock in a 12-year rate, and then they drop back to 3 or 4 over time, well, guess what's going to happen? They don't want that money back. They're making a hell of a lot more money off of you at 6% than they would be at 3. So that prepayment penalty is going to get even worse. So you will get eaten alive by that. So be very, very careful fixing long-term debt in a rising interest rate environment. So many more nuggets to come from that soapbox. We'll step down for now and relinquish the mic.
This is awesome. I feel like we gave some good stuff today, and I hope you have some takeaways, and we would love to learn and hear more of what you want us to share going forward as we jump on these calls, a little roundtable.
Absolutely. So folks, as Erin mentioned, please reach out to us at podcast@thequatroway.com. Just send, even if you just want to send a topic in the subject line, we will put it on the list and we will absolutely talk about it. We're going to start recording these once or twice a week and probably releasing them once a week as well. So you get to hear a lot more from the Quattro team. And, hope to provide some more value and get to know everyone better as the entire team, not just as Chad's face on the podcast. So this will be good. All right. Any parting thoughts before we go prep for our board meeting, team?
No, I just look to hearing what it is that you want from us so that we can provide value, and we look forward to it.
Yeah, this was fun. I like it.
It was fun. Maybe you'll remember to get dressed next time. It'd be great.
Maybe someone will tell me it's not just a podcast, it's going to be audio out there. Thank you very much. You are in trouble. You are grounded.
Yes. I'm 34 years old and still get grounded. It's cool.
Right.
All right, everyone.
Well, y'all have a good day.
All right. And this is the week of Thanksgiving. We're recording this. By the time you hear it, it'll be after Thanksgiving, but we want to belated wish all of you a happy Thanksgiving from Team Quattro. Until the next Quatro Roundtable, this has been the Quatro Roundtable numero uno, over and out.
That's right. See you later.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.